All right,
Can
that's
hear
great.
you, sir. Can hear you, sir.
All right, thank you. Our class shall continue from where we stopped last week. For those that were not in class last week, we are looking at the topic cost estimation. How can you estimate future costs? What are the methods of estimating cost? Why do we need to understand how to predict or estimate future costs? We discussed this last week. We said cost estimation is the measurement of historical cost with a view to predicting likely future costs. I'll take that again. We said cost estimation. This can be described as measurement of historical cost. You are measuring your historical cost, your past cost. Please, can you mute this Zoom user whenever you come to class? You are measuring historical costs with a view to predicting likely future costs. The purpose of cost estimation is to assist management in planning, controlling, and decision making. So the objective of cost estimation is to guide management planning, to control costs, and to assist management in decision making. If you are to prepare budgets, you must understand how to estimate costs. We now explain that for you to estimate costs, you require knowledge of cost behavior. We said the knowledge of cost behavior is a prerequisite for cost estimation. To be able to estimate cost, you must understand cost behavior. That is, how do costs behave relative to the volume of production? Your cost behavior shows how costs behave relative to the volume of production. We explain variable costs. These are costs that vary in direct proportion with the volume of production. The more you produce, the more the total variable cost incurred. But please note, variable cost per unit will be the same. Total variable cost will increase, but the variable cost per unit will remain constant. We explain fixed cost. Fixed cost. These are costs that remain fixed in total, regardless of the volume of production. We explain mixed cost. Chairman, please can you mute? Mixed cost. Peter side, please can you mute? Or Perry side, can you mute?
No spirit, you guys use spirit now. You use spirit. You guys should mute now.
Not spoil.
I wake up in the morning, go to my neighbors.
Thank you. Mixed costs. These are costs that contain both variable costs and fixed costs. We discussed this last week. We now look at method of estimating costs. We discussed engineering analysis method, accounts analysis method, scatter diagrams, high and low method, and regression analysis method. That was the discussion last week. Thereafter, we look at question number 2. Page 79, question 2. That question, we have solved the Apapa factory with a promise to look at Ikeja factory today. We also encourage students when you attempt assignments, it's a means of feedback to your lecturer. When you respond to a means of getting feedback, that will tell the lecturer the extent to which students understand the principle discussed, the areas that require improvements. But if assignment is given, and you don't respond, the lecturer will not know. All right, no problem. But please, you are encouraged. If you have assignment to do, create time for it. Now let's go back to that question. You can check page 79. Let's take the question again. Eko Akete Industries operates 2 factories. The other in Ikeja. The factory at Apapa is producing outputs in excess of sales demand, and it will be necessary to reduce production in the next period from the current 90% level of activity, in brackets 11,700 units, to 75%. The factory at Ikeja is also currently working at 90% level of activity, in brackets 8,100 units of a different product. But due to heavy sales demand, it is intended to increase output to 115%. You are given the following information about cost. We have Apapa factory, activity level, 80% material cost, direct labor cost, production overhead cost, and we have the sales value. Ikeja factory, from 80%, 90%, we have direct material cost, direct labor cost, production overhead cost. Mr. Joshua, please mute. Sales value. Requirements. Produce a statement to show expected marginal cost, contribution, and profits for each factory at the proposed level of activities. So you are going to do a Apapa factory at the proposed level. The proposed level is 75%. The company is planning to reduce output from 90% to 75%. So you are going to get expected marginal cost at 75% level of activity. At 75% level of activity, an expected profit at 75% activity level. This was done last week. We now have Ikeja factory. Ikeja factory currently operating at 90%. And the company is planning to increase for 90% activity. Mr. Ahmed, can you mute? The company is planning to increase for 90% activity level to 115% activity level. So we are going to get expected marginal cost at 115% activity level. We are going to get expected contribution at 115% activity level, as well as expected profits. So let's go to this. Like we explained last week, the activity levels were given to you in percentage. 80%, 90%, 110, 105. So your working one, calculate activity levels in units. Convert percentage to unit. Activity level. At 90% activity level, output is 8,100 units. You can use this to get other percentage. At 80%, the output will be 80 over 90 multiplied by 8,100. Calculate.
7,200.
7,200. At 100%, the output becomes 9,000 units. At 105, 105 over 90 multiplied by 9,450. At 110, 110 over 90 multiplied by 8,100.
9,900.
You can now get for the property level.
$10,350.
Thank you, ma. At 115%, new level, that becomes 115 divided by 90 multiplied by 1,100. That will give you 10,350 units. We have converted percentage. We have converted percentage to number of units. working to. Remember, we are trying to get marginal cost. And we explained that marginal cost. Marginal cost is summation of all variable costs. We now need to text direct material cost. Is it a variable cost or a fixed cost or a mixed cost? To answer this question correctly, you are going to text for cost behavior. Your text will tell you if the cost is a variable cost or a fixed cost or a mixed cost. We don't just assume that material cost is always a variable cost. It's like saying Panadol is always used for pain relief. Doctor will conduct tests because not all pains will Panadol treat. So we carry out tests for cost behavior. How do we do this? We are giving cost in total. You are going to take that cost to cost per unit. If you are giving the cost in total, you are going to take it to cost per unit. Now like this, for a Ikeja factory, we have the activity level to 110, output in units, also output in units, also given. Now pick direct material cost for Ikeja. If you check out, this is 7,900 at 80%, at 90%, 89,100, at 100%, 99,000, and so on. Now get material cost per unit. When we produce 7,200 units, total material cost 79,200. So total material divided by number of units. What is the material cost per unit here?
11.
11.
11.
11 naira. 11 naira. Next.
11. 11 naira.
11.
11 naira.
11 naira.
Next.
Throughout 11. 11 naira. Third one.
What are you?
The fourth one is 10.9.
10.8.
10.9.
10.8. Thank you. What do you have here?
7.7.
No.
10.77. Please don't attempt to round up.
Okay.
Don't say it's 11 naira or there's difference between 10 naira 80 kobo and 11 naira. There's difference between 10 naira 70 kobo and 11 naira. Now, if you look at it, when your production is within 100%, 80 to 100%. Your material cost per unit is constant. But when you produce above 100%, when your production exceeded 100%, your material cost per unit falls. Now the question is, why will material cost per unit fall after 100%? The likely reason is quantity discounts. By purchasing raw material above 100%, the supplier is giving you a discount. Your quantity is now above 100% purchase. The likely reason for this, why your material cost will fall, is because the supplier are giving you quantity discounts. That will now reduce your material cost per unit. In other words, if you make a note, this direct, let's make a note. Let us write it down. Let me write it down. Material cost per unit is 11 naira when production is within 100% level. At above 100%, material per unit falls as production increases. This may be due to quantity discounts received on the supplier. Please, in the exam, you don't need to write this. So I'm only writing this to aid understanding. Direct material cost, a variable cost. I need to make space. Direct material cost is still variable cost. But we need to use high and low method to determine material cost per unit when production is above 100%. We need to use and low method to determine material cost per unit when the production is above 100%. This principle in your head. Now, our concern is after 100%. If production is within 100%, direct material cost per unit is 11 naira. Above percent, what is direct material cost per unit? Can somebody confirm you can hear me clearly?
No,
I'm not
sir,
hearing you
breaking.
clearly. It's
Can't hear you
breaking.
clearly.
Yes,
It's
we can hear
breaking.
you clearly.
It's breaking. It's
It's
breaking.
breaking over here.
It's breaking here.
See, what normally ask this question is, they are all connected to network. If my network fluctuates, the system will notify me. That's why I repeat certain things. If your network fluctuates also, you will. This network, we are all connected to network. Either you are using MTN or Airtel or one particular network provider. But on my part, my system will always notify me. Your repeat.
We can't hear you.
You can't hear me.
Your line is breaking.
Your voice is cracking, sir.
Actually breaking.
It's actually the network. Yeah, it's network is fluctuating. But we try and see if we can also standard network. We'll
I can't hear you.
The network is very bad.
The network, okay, it dropped by 1 bar. All right, let's continue. Please, can you reconfirm you can hear me now?
Yes.
Better.
All right, thank you. Love it. Can you hear me?
Yes, we can hear you, sir.
All right, thank you. Lovett, can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear you. Can you hear me? Yes, we can hear Let's continue with the class. We now do high and low. After above 100%. You pick here, high, low, output, material cost. The highest level is 110. Please note, not 80. 80 is not the lowest level now. The problem is after 100%. I'm going to pick highest 110, 9,900. Your low is now 105, 9,450. Because the problem started after 100%. You are trying to get material cost above material cost per unit. When production is above 100%, so 1,900 units, material cost 106,650. You return here 9,900. Material cost 106,650. Low 9,450. Material cost 102,825. 102, 825. Now look for differences in
$450.
differences in output level, 450 units. Differences in material cost,
3825.
3825.
25.
Now get variable material cost per unit.
8.5.
8.5.
8 naira 50 kobo.
Cost per unit. Please remember, there is no fixed cost here. We are only looking at material cost after 100%. Material cost per unit. I will now do like this. Three 825 divided by 450.
8.5.
8 naira 50 kobo. What you are saying is, if production is within 100%, material cost per unit is 11 naira. When production exceeds 100%, material cost per unit becomes 8 naira 50 kobo as a result of discounts obtained. So we separated material cost within 100%, material cost outside on above 100%. Now go back to your statements. Look at the statements. Statements of expected marginal cost, contribution, and profits at the proposed activity level, 150. At this level, our outputs, 10,350. If you look at this level, this is above 100%. Which one are we going to use? Is it 11 naira per unit or 8 naira 50 kobo per unit?
8 naira 50 kobo per unit.
Any other opinion?
8 naira 50 kobo.
We'll use both.
All right. We are going to use both. Before you get to above 100%, you started from 1. Now you come and check here. For 100%, your output is 9,000 units. That means production from 1 to 9,000 units is within 100%. You have to produce 10,350. When you produce from 1 to 9,000 units, that is within 100%. Your material cost per unit is 11 naira. Look at it here. I want to expand this bus more. I want to expand the bus. Now look at this now. You are going to say 100%. That is 9,000 units. Material cost per unit, 11 naira. Above, that is greater than 100. Greater than 100. Now look at it. Out of 10,350 units, you have done 9,000 units. That is within 100%. What is the balance remaining? 1,350 units. Is that not? This 1,350 units is above 100%. This will be at 8 naira 50 kobo. You can now multiply. 9,000 multiplied by 11 naira.
9,000.
99,000. 1,350 multiplied by 8.5. What do you have?
11,475.
11,475. Now sum these two together. That is total material cost.
110,475.
110,475. You have gotten direct material cost. When production is 115%, we now move to labor cost. You are going to do same thing. Take the labor cost to per unit. 57,600 divided by 7,200 units. What do we have here?
8.
8.
8.
Next, divide.
8.
8. 8.
This 8 naira also.
Yeah.
Divide. 70
naira.
divided by 9.
8
Naira.
naira also.
8 naira also. Divide. 76.
That would be
8
8.09. So approximately 8.1.
8 naira 10 kobo. Next.
0.18.
8 naira.
18 kobo.
0.18.
18.
0.18. You observe that when your production is within 100%, labor cost per unit is 8 naira constant. But when your production exceeded 100%, labor cost per unit rises. What could have happened? Any opinion?
Sure. What? Is it increase in production?
When you produce above 100%,
Additional cost.
your labor cost per unit increases. What could have happened?
Because of increase in production.
Payment
Overtime.
Overtime.
When you are working above 100%, reasonably, management will compensate you. Management is giving worker overtime premium payments. That is why the labor cost per unit increase after 100% production. If you have to comment here, when production is within 100% level, labor cost per unit is constant at 8 naira. Full stop. but at above 100%, at above 100% level. Labor cost per unit rises. Production increases. This may be due to overtime premium. We need let me take that again. We need to use high and low method to determine labor cost per unit. When production is above 100%. You now do and low method. I'm trying to get space. One more. So if I do like this, high and low, output, labor costs, highest level 9,900. What is the total labor cost? Please reconfirm.
81,000.
81,000. Now your low level is now 105, 9,450. What is total labor cost?
76,500.
76,500.
Differences. 4,000. 450 units.
4,500. 4,500.
500.
450.
Variable labor cost per unit.
10 naira.
10 naira.
Variable labor cost per unit. 4,500 divided by 450 units.
450.
10 naira.
10 naira. God bless you. Let me take what. You now return to your statement. Again, you are going to separate the first 9,000 units is within 100%. That would be 8 naira. Labor will be paid 8 naira per unit. When labor work within 100%, the balance out of 10,350, we have produced 9,000. Balance is 1,350. The labor will be paid 10 naira per unit to compensate them for going above 100%. So multiply. Multiply. Total, please.
9,000 times 8 is 72,000.
86,300, right? Oh, no.
9,000 times 8 is 72,000.
72,000. 9,000 times 8 naira
Yeah, I couldn't done that, sir.
at 100%.
85,500.
85,500.
Correct.
You are done with the labor cost. We now move to production overhead. Again, you are going to take it to per unit. Look at the production overhead cost. Take the cost to per unit. 49,800 divided by 7,200. Give your answer in 2 decimal places.
On 6.91.
91.
6.59.
91, 6.59,
6.33.
6.33,
6.13. And 6.12.
What is the next point? It should be 2, 2.
2, yes. Then 6.1.
Now what can you draw from this?
Missed cost. Is missed cost.
Missed cost. You observe that from the beginning, as production increases, total overhead cost also increase. But overhead cost per unit falls. Is that not? If you look at it.
Yes, sir.
Yes.
As production volume increase, total overhead cost also increase. But overhead cost per unit falls. This is a confirmation that this production overhead is a missed cost. Any cost that shows these characteristics is a missed cost. Let me write it down for you. As production volume increases, total overhead cost also increase, but overhead costs per unit falls. This is an indication that the production overhead cost is a mixed cost. It contains variable overhead and fixed overhead. Please, in exam, you don't need to write this. So I'm writing this so that this knowledge can be clear to the students. Examiner is aware that you are battling with time. In this case, we use high and low to set the cost, to separate the cost. For this overhead cost, the highest level is 110, the lowest level is 80, because the problem started from the beginning. You now come here. High and low output, overhead cost at 9,900 units. What is the total overhead cost?
6,600.
5,600. At low, 7,200. What is the overhead cost?
49,800.
800.
Differences.
27.
2,700, then 10,800.
10,400. 400.
Ah, 400. Sorry.
Abi, is it 100? Is it 100?
I'm right now.
10,800.
800.
800.
We require space. We are going to require space here. Let me check something. Which one will be faster? Can I copy this, cut this out? Take this out. Take it down small. Come to the next page. Let me bring this one here. Oh. Mr. Eniolonda, you tried. You made a good attempt.
Thank you, sir.
So you now get your, close this, our variable overhead
Per unit.
per unit.
4 naira.
You don't worry, talk.
Our variable overhead per unit, that will be 10,800 divided by 2,700. That is
4
4
naira.
naira per unit. When you get this, remember that for this particular overhead cost, there is fixed cost.
Yes.
Unlike material and labor, we are trying to separate the fixed overhead cost and the variable overhead cost. We have gotten variable overhead cost per unit. Now determine total variable overhead.
9,912.
You can do this either at the highest level
Yes.
or at the lowest level. At high level, total variable overhead is equal to, at high level we produce
9,900
units, and we set variable cost per unit.
4 naira per
Variable
unit.
per unit, 4 naira.
4 naira.
Total will give me how much?
39,600.
39,600. Now look at it. At high level, total overhead cost 60,600. This total overhead cost contains variable overhead and fixed overhead. We have calculated total variable overhead 39,600. Out of 60,600,
We can't hear you.
I can't hear you. We can't hear you. The line is breaking.
this line stop breaking. Oh,
Stop breaking. Oh.
can you hear me now?
Yes,
Breathing.
yes, I hear you.
Every business has its own business risk. If you are dealing with online business, you can have connectivity. So we'll try to manage it. I already in 2 days. I can access my bank app. Let's go on. We said you have calculated your total variable overhead at high level, 39,600. If you look at the high level, total overhead is 60,600. If total variable is 39,600, what is total fees?
21,000.
21.
60,600 minus
39,600.
39,600. That will give you 21,000. You have separated the cost. Like I said, you can either use at high level or you can use at low level. Total fees cost will be the same, whether at the high level or at the low level.
I can't hear you.
Can you hear me now?
Yes, we
Yes.
can hear you.
All right, let's go on. We now return to our statement. We have separated the cost. The variable overhead per unit is 4 naira. So if you produce 10,350, what is total variable overhead? We can do that here.
It's one.
Just come here. Let me expand this more. If you produce 10,350 units, variable overhead per unit 4 naira. That is 41,000. 41 was
400.
400.
400. You have gotten your variable cost. You can get your marginal cost now. Direct material plus direct labor plus variable overhead. Those are the variable costs. What is the total variable expected marginal cost? Sum up.
237,375.
237.
375.
So what you are saying is at 115% level of activity, this company will incur 237,375,000 expected marginal cost. If production is next is your contribution. If we produce and sell 115% level, what is the expected contribution? That means I need to get my sales value.
Sales value, yeah.
What is selling price per unit at Ikeja factory? You are giving the sales value. And you have the volume.
120 starting there.
We should have it here, okay? Yeah, you are correct, but let's show the working. Sales value divided by number of units. 30 naira.
Oh,
30 naira. 30 naira. 30 naira. The selling price per unit is 30 naira. At Ikeja factory. So let's go and get the sales revenue. Yeah, any along there, far away.
Yeah, yes, sir. I want to quickly ask. Let's assume that the selling price is not constant. Are we going to use high and low in that regard?
No, sir.
Okay.
High and low method is for cost analysis, not revenue. The high and low method is for estimating cost. It's not for estimating revenue. All the costing method, engineering analysis method, account inspection method, scatter diagrams, high and low method, regression analysis method. They are for estimating cost, not revenue. Selling price is for your revenue. Now, examiner should not give you different selling prices. But if it happens that the selling price is not the same, that means examiner must specify the one you are going to use. That means most likely we are doing price discrimination because company selling price will be the same. If you are buying bottled water, whether you buy in Lagos, the price is the same. Okay, this is it. I will now come here. We are going to sell 10,350 units at a selling price of 30 naira. What is the total sales value? Hello.
That's 310,500. 310,500.
You can now get your contribution. Sales value minus marginal cost. What is the contribution?
73,125. 125.
Thank you. The Zoom user. To get our profits, contribution less total fees cost, fees overhead cost. Our total fees overhead cost is 21,000. What's the profit?
52,125.
125.
125.
19 members. All right. So please, cost estimation is a topic you are going to, it's not a standalone topic. When you come to cost estimation, it's not a standalone topic. It's a topic that is related to every topics under PA. When you are talking of budgets, you are going to estimate cost. When we get to the next topic, price theory, you are going to require knowledge of cost estimation to determine the price of a product. You must know the cost of that product. To determine the appropriate selling price for your product, you require the knowledge of cost. How much will it cost me to manufacture this product? I cannot determine, please, somebody is touching my screen. I think SM. Each time you are touching my screen, to determine the price for your product, you must know the cost of that product. So this topic, you are still going to meet it in subsequent lectures. All right. On that note, let me save this first. We close discussion on cost estimation. We now move to the next topic. What is the next topic? Price theory. You are going to see, when we get to price theory, we are still going to bring back high and low method. Possibly we are going to look at regression analysis method. Let us move to that topic. You can take your study pack. Look at the content where you have pricing decision. I'm going to share it now. Price theory. Let me use this. No, this one, I can't use this. This can't work. Pricing decision. Okay. Please confirm, somebody confirm. You can see my new screen.
Yes.
Yes, I can see it.
All right. To appreciate this topic, why you must understand this topic, it affects me and you. How do we determine the price for our product or service? You must be selling something. Either you are selling products or you are selling your service. How do companies determine price for their products? If you are to buy a bottle of Fanta, you pay 500 naira. How do this company, or how does this company determine the price of 500 naira? Maybe if you have to buy Pepsi or other products, you pay less. How do companies determine price for their products or service? Pricing is very sensitive. It's a very sensitive decision making. To determine price of a product, at times you go to market today, the price of the product is 1,000. Within the next 1 hour, the price may increase to 1,500. What has happened? Assuming I'm to ask you, you are faced with interview. You are being interviewed for accounting job. And your employer asks you to name your price. How much should we pay you? If I'm to ask randomly, and name your price. How much do you want? Assuming we are to hire you as an accountant. Yes, we are waiting.
1.2 million net.
Annually.
Monthly. Monthly.
We did 50
1.2
certificate,
million.
Abby.
1.2 million net.
1.2 million monthly. Wow. Okay. Zoom user, name your price.
$1 million, 1.2.
Are you related to Olonda?
That's the market price now, the market value now for a chartered accountant. 1
Okay.
million, 1.2.
You want 1.2 million.
Yes, sir.
All right. The question is, your employer can choose not to hire you on the basis of that price, or the employer can choose to hire you. That goes to tell you how sensitive pricing can be. If you name 1.2, So you are looking at like 13 million annually. The employer can choose not to hire you. What are we trying to say here? Pricing is a very sensitive decision. Regardless of the nature of your business or size of your business or complexity of your business organization, the most important strategic decision faced by senior management is setting appropriate selling price. For many products and services, selling price is the primary determinant of quantity demanded. Your selling price will determine quantity customer will buy. Pricing decision affects contribution per unit as well as volume of sales. Pricing decision must be made and reviewed regularly. Price is not static. Pricing decision can be used as a weapon to achieve competition or to destroy competition. You can use your price to destroy your competitors. You can also use your price to encourage competition. Price is an element that creates sales revenue. There are several factors that determine the appropriate price. These factors include: 1, long-term corporate objective of the organization. What is the corporate objective of the organization? Some companies are established for profit-making purposes, while some organizations are established not for profit-making. Your objective will affect your selling price. Number 2, nature of the company's product. Nature of your product will affect price of your product. Is your product luxury or necessity? Is your product durable or perishable? The nature of your product will affect price of your product. Number 3, actual production cost. The actual production cost will affect price of the product. Number 4, the degree of competition. If competition is very high, you can increase your prices anyhow. If the market is competitive with similar products, number 6, the elasticity of demand. Demand elasticity of the product. And lastly, nature of the market. Nature of the market can affect price. All right, a small digression. Somebody was asking the B part. We have explained the B part. Those examiner says, why is the treatment for Ikeja different from the treatment for Apapa? Is because at Ikeja, we are working above 100%. But at Apapa, we work at 100%. Requirement B has been answered by those notes we are writing. All right. We have introduced costing. We have introduced pricing. What are the methods of setting prices? What are the methods that you can use so as to determine the selling price of a product? We have the cost plus method. Cost plus pricing method. Cost plus pricing method. This is 1 minute. Under this method, we have 3 types. Again, pricing method. We have 3 types. You have full cost plus pricing method. Full cost plus pricing method. This method is also absorption costing. Absorption. Both and the fee so as to establish.
Hello, sir. We can't hear you.
Your voice is breaking.
If you are speaking, sir, we can't hear you.
Hello, can you hear me now?
Yes, sir.
Yes.
All right. Let me take cost plus full cost plus pricing method. We said this method is referred to as absorption cost plus pricing method. Under this method, both your variable cost and your fixed cost is included in the total cost of a product. Full cost, both your variable cost and your fixed cost are included in the total cost for a product. Thereafter, certain percentage markup will be added to the total cost. Thereafter, certain percentage markup is added to the total cost of the product, so as to arrive at the selling price. When you say full cost plus, you are going to pick the total full cost, both the variable cost of the product and the fixed cost of the product. This will be added together so as to get the total cost of the product. Certain percentage markup will be added to the total cost so as to arrive at the selling price. This method is used for planning purposes. The full cost plus pricing method is mostly used for planning purposes. That is number one method. Number two method. Variable cost plus pricing. We also call it marginal cost plus pricing. Marginal cost plus price. Under this method, only the variable cost, only the variable cost of the product will be taken into consideration in order to estimate selling price. Under this method, only the variable cost of the product will be taken into account so as to estimate selling price. In addition to the variable cost, in addition to the variable cost of the product, certain percentage markup will be added to the variable cost. So as to arrive at the selling price. The marginal cost plus ignores fixed cost. It separates relevant costs from irrelevant costs. The marginal cost plus system differentiates between relevant costs and irrelevant costs. Variable costs are assumed to be relevant to production. Variable costs are assumed to be relevant to production, while fixed costs are assumed to be irrelevant costs. The fixed cost will be incurred whether you produce or you don't produce. This is number 2 method. Number 3 method, target return pricing method. Yeah.
Sir, please, I'm lost at where you said certain percentage markup will be added to the what?
So the total variable cost.
Okay. Thank you.
You're welcome, man. Number 3, target return pricing model. It's also called target return on investment pricing. Target return on investment. Target return on investment pricing. Before this, please note, marginal cost plus method is used for decision making. Marginal cost plus pricing method is used for decision making. Usually, short-term decision making. Your target return on investment pricing can be used to achieve a specific return on investment. It can be used to achieve a specific or a target return on investment for the owners. Under this method, the total cost of the product is estimated. Under this method, the total cost of the product is estimated. In addition, certain a target return on investment, a percentage target return on investment will be added to the total cost. a target percentage or return on investment will be added to the total cost of the product, so as to arrive at the selling price. The method is mostly used or to achieve a satisfactory return on investment, or to achieve a satisfactory return on investment for the provider of capital. These are the methods. Please hold on. These are the methods that are commonly used to determine selling price of a product. These are the methods that are commonly used. So as to determine selling price of a product. Right. Our next discussion, pricing strategy. We call it pricing strategy, the strategy of pricing. When we say pricing strategy, if you are planning to launch your product for the first time, you have a new product, though you are planning to introduce to the market. When the company is planning the market for the first time, the company must decide on the appropriate pricing strategy to use. If you are bringing a new product to the market for the first time, you have to decide on the appropriate pricing strategy you are going to use for your product to launch your product onto the market. There are different pricing strategies. There are different pricing strategy company uses. But there are two major pricing strategies. There are two major pricing strategies. What are these strategies? One, market skimming pricing strategy or strategy. Market skimming pricing strategy. What is market skimming? How can we skim the market? Market skimming is a of charging higher price. Introduce
Please, can you come again? I can't
we
hear
say
you.
Your voice is breaking. You can't hear properly.
market scheming. Market scheming involves charging higher price when a product is first launched onto the market. You are charging higher price when you introduce your products to the market for the first time. I hope it's better.
Yes.
How you can hear me now?
Yes, I can hear you.
It's not my voice, it's network that is holding, it's network that is fluctuates. It's not my voice. My voice is consistent. When you get the video, you observe that it's network that is fluctuates. So when we say market scheming, a strategy of charging higher price when a product is newly introduced to the market and using advertisements to obtain higher sales. The objective of market scheming is to obtain higher profits at the early stage of the product life cycle. You are charging higher price when you newly introduce your product to the market. Your aim is to achieve higher profits, is to make big profits at the early stage, of the product life cycle. When company introduces a new product to the market for the first time, it might choose a pricing policy based on market scheming. Because the product is new, some customers might be eager to buy the new product at higher price. Some customers are desperate to buy the new product at an higher price. For that desperation, you can charge higher price. But please note, market scheming cannot be used when competitors have rival products in the market. It might be difficult to use market scheming when competitors have already introduced a rival product to the market. Customers in the market who have gotten an idea of the price expected to be paid. They will compare the price with rival products. You can easily skim the market. Where your product is unique, where your new product is unique in functionality, or in quality, and there is no similar or rival products in the market. So you can do market skimming. If you flash back to 1999, when GSM was newly introduced, then we have MTN components. What they did to Nigerians is market skimming. MTN, Econet were charging higher price to buy lines. If you are to get MTN line, you pay higher price.
I hear you
That's
again, sir.
market skimming. Number two strategy, market penetration. Market penetration pricing strategy. This is the opposite of market skimming. A direct opposite of market skimming. An alternative pricing policy to market skimming. It involves charging low price. When a new product is launched onto the market for the first time, it involves charging a low selling price. When a new product is launched onto the market for the first time, the objective of market penetration is to enable the company to achieve higher sales volume as quickly as possible. Before competitors can introduce rival products. You want to achieve volume. You are charging a low price. You want to draw customers to your products. Many customers are likely to buy the product because the price is low. For market penetration to work, the company must be a cost leader. The company must pursue a cost leadership market strategy. for market penetration to work, the company in question must be able to be a cost leader. A cost leadership strategy is a strategy of trying to become the lowest cost producer of a product. A cost leadership strategy is a strategy of trying to become the lowest cost producer of a particular product in the market. Low cost production can be achieved through economy of scale. Through economy of scale, you can achieve low cost production by looking at economy of scales and large scale production. Market penetration pricing is consistent with cost leadership strategy. You should be able for you to charge low cost for your products. You must be able to produce at for you to charge low selling price. The company should be able to produce at a low cost. Production at the lowest production cost. You can achieve this by working towards economy of scales or by doing what we call large scale production. If you are able to produce at a low cost, then you can afford to charge low selling price. When you charge low selling price, customer will patronize your product. You are going to achieve higher sales volume. Most customers will want to buy your product because it's cheap. With that, you can penetrate the market and capture larger size of the market. You capture larger share of the market. This is market penetration. If you look at, I have like two examples that I observe in practice. Look at Technophone. When Techno was introduced to Nigerian market for the first time, Techno brand, the company introduced the products at a very low price. They have existing phone in the market. Techno was launched onto the market at a low price. The low price enables the company to generate higher sales volume. Over time, the company starts increasing its price too. The objective is to capture larger size of the market. Once you have captured larger size, you can now increase your price gradually. These are the two methods that are mostly used when launching a new product. All right. We still have other. We are still going to discuss theoretical approach to pricing. The time is gone. We can't do that today. Let's stop here today. Any question? Clarification? All right. We shall call it a good night. When we meet next week by God's grace, we shall apply question to what we discussed today. On that note, I will be checking out if there's no question.